Hi everybody, welcome to another awesome, amazing Kahota whiteboard video session. Today we're going to tackle the topic of why I invest in rental real estate. And that's a question that I get asked a lot, whether it's friends, family, clients. They all want to know, Sean, why do you prefer real estate over things like stocks and IRAs and bonds and paper assets? Well, the answer is pretty easy, and I'm going to show you some math on a deal that I actually have in progress right now. So these are real numbers, and let's get started. So here is the purchase price of the property that I'm in the midst of closing on in Memphis, Tennessee. So the purchase price on that property is going to be $67,200. Now this is a single family residence. It's a one door unit, if you will, single family home. And you're probably saying to yourself, Sean, there is no way I can get a property for $67,000 in my market. Well, you know what? Neither can I. So that's why there's that old saying, live where you want to live, but invest where it makes sense. So I choose to invest in markets in the Midwest, in the South, where the property prices are lower. Also, it's a little more of a blue collar area, and the rent to price ratio is still really good, which you're not going to get in the North or in the West or on any of the coasts. So we're going to talk that through in a minute, but that's one thing that you should look into if you're going to invest. Don't feel like you have to stay in your own backyard. The deals may not be there. So the purchase price on this one is $67,200. I'm going to put the traditional 20% down. So that's going to be $13,440 down, 20%. There'll be some closing costs and stuff in there too, but for this exercise, we're not going to figure that. The mortgage then on that would be $53,760. Now, this particular unit, I already know that it will be rented when it's finished, being rehabbed and reconstructed. So the rent there will be $675 a month. And I want to spend a second on this for a minute. This number is really important. You want to go for the rule of 1%. $675 as a rule of the purchase price. If you can get around 1%, which you'll see here, we're slightly over 1%, 672 would be 1%. If you can get your rent to purchase price ratio to be around 1%, that's amazing. 0.8% would work, 0.9% would probably work as well. Those are about as low as you want to go. You start to go any lower than that, your property is just not going to cash flow. So this one's right in the sweet spot. We got a 1% rent to price ratio, which is really hard to get in a lot of markets, which is why I go to specific markets in the South and Midwest. So Memphis is one good example of that. All right, so $675 a month it's going to rent for. So let's do some math. We've got our income. That's easy. $675, right? So now how about our expenses? Well, I went ahead and figured the mortgage ahead of time, and that's going to be $289. And that's going to include principal and interest. And I'm probably going to get about 5%. So for those of you that are doing the math at home, 5% interest rate figure in there. A lot of things depend on that, your credit, your debt to income ratio, a lot of that other stuff. But for this exercise, I'm going to do 5%. The taxes. Here's another reason I don't buy in my market. I live in a state that has one of the highest tax rates, New York State. So besides us in California, no other state pays as much as we do. So it's really hard to make the numbers work in New York State. Down here, the taxes on this property will be $603 per year. So that's $50 a month in taxes. The next thing that I already got a quote on is my homeowner's insurance. It's going to be $384 a year. Again, it's fairly low. $32 a month in insurance. In this market, I already know that people bring their own appliances. They maintain their own property, like cutting the grass. You don't have to deal with snow removal like I do in New York State. They'll also pay for their own water, utilities, all of that kind of stuff. So, as I've said a couple times in this video already, I don't live in Memphis, so I need someone to manage that property for me. So thankfully, I have a relationship already with a property manager in Memphis. So it's really easy for me to just add this property to the stuff they're already managing, and that'll be easy for them to just add that. So property management for them is, they do a really good job. So they have 10% of the rent is what they charge. Anywhere between 8 to 10% is probably the going rate for that. So 10% of $675, let's just round it off to $68 a month for property management. I do not want to self-manage this property. They do a really good job of renting it out. They'll make sure that there's, if there's any issues with the tenants, they handle all of that. I get a bill a statement each month. I have a call once in a blue moon. And that's what truly will make this passive income. So you're not having to manage that actual property. All right, so total expenses per month, $439. So doesn't take a rocket scientist, but we are already ahead, and we're going to see what the cash flow is. Cash flow on that is going to be $236 a month cash flow. Or over the course of a year, $2,832. So what I'm going to do at this point is I'm going to let you know that because this is a turnkey property, it is going to be completely rehabbed. It's going to have a brand new roof, brand new HVAC, new windows, new landscaping, new hot water tank, all of those kind of things, new flooring and sink and tub and tile and all of that kind of stuff. Traditionally, I'm going to figure probably about 10% for capital expenditures and vacancies. I'm feeling pretty confident about this one because it is going to be completely rehabbed, but for the sake of benefit, let's still take out the 10% for vacancies and capital expenditures. So worst case, let's say we take another 10%, $68. That would take off about $800. So let's just say there's about $2,000 a year cash flow. Now, how do we figure out what our rate of return is on this? Well, it's easy. You take the $2,832, you divide by your investment, which is the upfront money of $13,440 that you put down, and the return on that is 21%. Now, let's say that I am going to put aside that money, but let's say I actually have to use it, and my rate of return on this one would be 15%. Neither one is bad, right? So my rate of return will be somewhere between 15 and 21%. Now let's take a look at what's going to happen after 7 years. 7 years, 6, 7, 8 years, somewhere around that range is normally when things start to go. If you're a homeowner, you know what I'm talking about. Maybe you need some siding, maybe it starts needing paint or new flooring or hot water tank, things like that. They're going to start to maybe need some maintenance. The house will need some maintenance maybe around that 7-year mark. So what I like to recommend is around 7 years, consider if you want to stay in that property or not, because now you're definitely going to be putting in some money. Up until then, maybe you've been lucky because it is a brand new property. So here's what the numbers look like after 7 years. Because we have our tenant paying it down, we're going to go ahead and assume that they pay down the mortgage at about 2% a year. It's usually a little bit more than that, but let's just say 2%. It's a nice round number. So after 7 years, we're only going to owe $46,800 on that. So let's see, about about $7,000, give or take, somewhere in that range, has been paid off in the 7 years. But the really nice thing about that is I didn't pay it off. The tenant paid it off. Yeah, I physically made the payment, but using their money. So that's the beauty of rental real estate. The tenant pays down the loan and pays down the mortgage. The Memphis market usually appreciates somewhere around 3-4%, somewhere in that range. But again, conservatively, let's look at 2%. So the property that's worth $67,200 today, what's it going to be worth 7 years from now? Well, if it appreciates at 2% a year, it'll be worth roughly $77,200 over those 7 years. Pretty darn good, right? I didn't have to do anything for that, and it appreciated $10,000, and the tenant paid off another $7,000. All right, so let's say at that 7-year mark, I decide to sell it. The difference between $77,200, $46,800 is $30,400 of value and equity that we have in the house. So that's ours. On top of that, we've been getting paid this every single year for 7 years. So you take the $28,32 times 7, we got another $19,824 in cash flow over 7 years. Add that together, that's a grand total of $50,224 that we are ahead on this property after the 7-year mark if we decide to sell. Now, we want to figure out what the rate of return is on that because we did put some money into it up front, right? So that's not all pure profit. So we take off the amount that we put down minus the $13,440, and we are left with $36,784. Now that is our profit. Now if we want to determine what the rate of return on that was from our initial investment, you take the $36,784 divided by $13,440, and you'll see that you have a rate of return of 274% over 7 years. That's amazing, isn't it? Now, a lot of people, if you compare it to stocks, are more used to hearing the phrase average rate of return. So let's do that. 274% divided by 7 years. It was 7 years. So we are averaging, it was like the high 39s. So let's just call it 40% average rate of return. Right around 40%. Pretty darn good, right? Over the last 100 years in the stock market, you'll hear financial advisors and television articles and stories and things like that talk about the average rate of return in the stock market is 10% annually. So we've got 40%. Now the 10% that they talk about in the stock market is prior to inflation, prior to fees, anything like that. So your 10% is probably looking more like 5% in the stock market. But let's say it is 10. Which of these is better? Which of these is giving you a better return? Which of them is more risky, would you say? Investing in companies that you have zero control over, giving your money to Wall Street and hoping that it's there when you're ready for it 7 years later, 20 years later, 40 years later? Or investing in a hard asset that you know somebody's going to live in, you know they're most likely going to pay you rent for it, and you know what, we can get out of it after 7 years if we want, turn a nice profit. These are all conservative numbers, and there's a history to it. Just like there's a history of the stock market doing 10%, there's a history of things like people will pay your mortgage down 2% a year. The average appreciation is usually above 2%, but we figured it at 2%. So those things are just as reliable as the stock market doing 10%. The other thing that we didn't figure in this 40% because it's too much work is the average hedging against inflation and also tax savings that we would have. But again, that's just an extra added bonus. No need to figure the math on that. So take a look at this, and hopefully this answers the question why I personally invest in rental real estate, and I really would recommend that you do as well. Is it really any surprise that wealthy people have real estate and own it? That's what makes them wealthy. And if they have a business that made them wealthy, they invest in real estate because it's one of the most proven ways to multiply your money going forward. So if you have any questions, reach out, let us know. We're happy to answer, walk you through anything. Check us out at Kahota.com or any of the social media platforms and subscribe to our channel. Thanks so much. Have a great one.